Basically, like every business prepares financial reports. Okay, this is for the sake of shareholders or the owners. Every business also prepares tax returns. This is nothing but they have to pay taxes to the government. Okay.
Yeah.
So they prepare income, they do the assessment at the end of the year and they pay taxes. Fine. You generally know that this is done in like financial year. In India, we start our financial year starts from when?
April to March.
April 1st to March 31st. Every company should do their return filing in this period. Okay. Okay.
Okay.
And this is what like is about the tax like period. This is the period in which tax returns are to be filed and to be like the taxes are to be paid and settled. Okay, generally they do this. Here the year can start like from Jan 1st to December 31st. Okay, this is also called as fiscal year when we pay taxes. This is like a normal year, like academic year. You can say like financial year. This is financial year generally. This is what also the companies do. They like prepare the books of accounts or financial reports at the end of the year, December 31st. Okay, some companies do this also. So what they are asking with this, the first question is income tax basis. Yes. Financial statements. That means they are speaking about what? Tax returns. Am I right?
Yes, sir.
Correct. Income tax basis financial statements or the financial statements, whatever you prepare under income tax basis, differ from those prepared under GAAP because why? They do not include non-taxable revenues and non-deductible expenses in determining income.
No.
Why they differ actually? Whatever the tax returns and the and this like financial reports we prepare.
For the state also.
See, do not include non-taxable. See, many of the revenues are included in US GAAP, but they are exempted from income tax returns. Am I right?
Yeah.
So do not include non-taxable revenues. So see, whenever we follow US GAAP, it of course differs from the what we say, whatever we prepare the tax returns. Am I right?
Yeah.
Okay, because the asset and liability which we show in financial reports, like by following the US GAAP, is very different from the from the income from the assets and liabilities what we are showing under income tax returns. Okay, because there we follow a different concept. Here we follow different concept. Correct?
Yes, sir.
And like I'll read some points here. See, financial statements prepared under the income tax basis of accounting and financial statements prepared under US GAAP differ when the tax basis of an asset or liability and its reported amount in GAAP based financial statements is not same. That means when we show something in tax returns and we show something in financial report, if these two don't match, then definitely you see differences. Correct?
Yes, sir.
Did you understand, Suman?
Yeah.
Yeah, the figures which you are showing in the tax returns and reports, if they differ, differences definitely would be seen. And maximum times they don't match and we see the differences. That is the reason why DTA, deferred tax asset and deferred tax liability is created. Okay.
Created.
The result will be taxable or deductible amounts in future years. Taxable amounts is nothing but future you have to pay taxes. Deductible is nothing but in future that will reduce your taxes. I'm speaking about deferred tax asset. Understood?
Yeah.
Yeah. So the result will be taxable or deductible amounts in future years when the reported amount of the asset is recovered or liability is settled. So what happens is, since these two are having different the things, what happens is we show certain things first in the income tax return and we show it afterwards in the financial reports. We recognize certain things before in financial reports and show it afterwards in the income tax returns. This is the only like reason because of which these two differ. Am I right?
Yes, sir.
So one small example is if you receive subscriptions in advance or income or rent in advance. So when you receive rent in advance, you immediately show that in the tax returns. Am I right?
Yeah.
As revenue. Why? Because we follow cash basis when we prepare tax returns. Understood?
Yes, sir.
Hello.
Yeah.
See, my tenant has paid me rent for the entire year in advance. I received the entire 1,20,000 rupees from him in cash on January 1st. So when I prepare tax returns, I will show that entire as revenue only. Why? Because here we believe in cash basis. Fine. When we receive, we show. But as per the financial reports, do you think this is right? No.
No, sir.
It's a liability for you in
Liability.
actuality because you have not given services of that rental yet to your tenant. So when first month passes by, then you will recognize 10,000 as revenue and 1,10,000 as outstanding liability. Am I right or wrong?
Okay.
Are you understanding, Suman?
Yeah, sir.
Yeah, in financial reports, first month has passed away. So my obligation, whatever was there to give rental service to my tenant, of that 10,000 got reduced. That means he the Jan 1st has Jan 31st has passed away. February month has come into picture. So first month rent I received now. So my first month rent 10,000 is my income, and my liability, which was of 1,20,000, now has reduced by 10,000, and now my outstanding liability will be 1,10,000. Correct?
Yeah.
Yeah.
In this way, when I enter into December 31st, my entire obligation is set off. I have no liability now, and the entire 1,20,000 I'll recognize as revenue. So these two are creating changes or not? Yes, they are creating changes, correct?
Yes,
Yeah.
sir.
So temporary differences most commonly arise when either expenses or revenues are recognized for tax purpose either earlier or later than in the determination of financial income. So the most important aspect here, the prime reason of these two books differing or tax returns and financial reports differing is nothing but recognize certain revenues and expenses in different reporting periods, correct? We
Yeah.
recognize something before in tax returns, and in financial reports we show them later, or we recognize something before in the financial reports and show them later in the tax returns. So this is the prime reason. Okay, so just see the assessment of this question. See, do not include non-taxable revenues and non-deductible expenses in determining income. How come that is? Non-tax, this is permanent difference. Understood?
It is, yes, sir.
Yeah.
Yeah, so so income tax basis financial statements differ from those prepared under GAAP because they are shown in different periods. That's it. It is not like we are not showing certain incomes should not be shown in financial in the tax returns. Certain incomes should never be shown in the tax returns. That is understood fact. Okay.
Yes, sir.
Yeah, that is for the permanent difference. The main reason is this. Shall we go ahead?
Yes, sir.
And you know, like, sir, this was from the perspective of tax returns. If I see from the perspective of financial reports, there is a warranty liability. So warranty is, you know, every company gives warranty to their customers. So we make a provision for this, and those provisions we recognize beforehand in the financial reports. Am I right?
Yes.
We make provisions now. Provision means we will incur some expense in the future. For that we make a provision beforehand. Understood?
Yes, sir.
And those provisions we show in the books. Okay, later under provision over provision we can adjust. So every company, suppose my company has set a provision of $1 lakh for warranties. So that is an expense which I will recognize beforehand. But what happens under the tax returns? It will only be recognized when it is paid. Are you understanding? It may be paid later. It may be paid next year, whatever it is. Whenever it is paid, then only it will be recognized. So this is creating a difference between these two books. Only what is creating difference? Things which are shown in different reporting periods. That's it. Okay. So we'll go for the question number 2. If any doubts, you can ask me. I'm waiting.
Hmm.
Any doubts?
Not
Yeah,
related.
see, fines and fees you show in the financial reports, but you cannot, but it is not shown in the, what we say, tax returns. LIC premium, whatever the LIC, like policy premiums, whatever you are paying, it's your personal expense. Okay. So, you can claim deduction on such kind of things in your tax returns. Fine. So like there are many expenses, or suppose like you are receiving some income from government securities. Let us say you are receiving some income from some government securities. Those are non-taxable revenues. They will never be shown in the tax returns, but they will be shown into the financial reports. Correct? So
Yeah.
these are permanent things. But the what they're asking is, as per the financial statements what you're preparing as per income tax returns and as per the gap, the differences are created because here you are showing later, there you are showing before, but the transaction you are showing now in both the books.
Yes.
Okay, this subscription, whatever the rent I received in advance, I'll be showing in both I'll be showing under tax returns and I'll be showing under financial reports, but I'll be showing at different periods. Okay, so that is creating the difference. Something which I don't show, something won't come into that, is something which we ignore. We cannot do anything about that. Understood? So this is the prime reason. Anyone got any doubts?
No, sir.
See, differences are created because you show the same thing in both the books at different periods. It is not created because something you show in some book and another book does not have that particular thing at all. Okay, that is not the difference. Okay, difference is because of this only. Go for the question number 2. So they're asking you, temporary differences arise when expenses are deductible for tax purposes after they are recognized. After they are recognized in financial income, before they are recognized in the financial income. So temporary differences arises when expenses are deductible for tax purpose. That means expenses which are showing in tax returns. Correct?
Yes, sir.
After they are recognized in financial income, before they are recognized in financial income. Yeah. See, temporary differences arise when expenses are deductible for tax purposes after they are recognized. That means you are showing at different time periods. That's right.
Yes, sir.
See,
See,
after they are recognized in financial income, that means you have recognized that before itself in the tax returns. Am I right?
Yeah.
See, after they are recognized in financial income means before itself you have recognized in the tax returns. Before they are recognized in the financial income means afterwards you'll recognize in the tax returns. Am I right?
yes, sir.
Yes. So what is the answer for this?
Yes.
See?
Yes. Yes.
Yeah, that's what. Okay. Next question. Did you understand now this one?
Yeah.
Yeah.
Okay. Go for the next question. So what happens here is, please try to understand what I'm doing. Okay.
Yes, sir.
See, Lucas Company computed the following deferred tax balances for the two most recent years. That means year 1, year 2. Year 1 deferred tax asset is how much? 9,000. Year 2, 17,000. That means how much is the difference in deferred tax asset?
8,000.
8,000. Okay. That means this much increment is seen. Okay. And what is the difference in deferred tax liability?
10,000.
10,000. That means this much increment is seen in both the accounts. Okay. If Lucas calculates taxable income of this much for year 2, so they have given the taxable income for year 2 and the tax rate is this. So what would be the taxable amount according to you? We will take that income. See, always you pay taxes on taxable income
Taxable
or
income.
financial reports income. That means net
Tax.
profit.
Taxable
Tax.
income.
Of course, taxable income. Taxable income means the income which you see in the income tax reports,
Yes.
income tax returns. Okay. This is tax return. This is financial report. This will give you net profit or net income. This will give you taxable income. On this you pay taxes. So my taxable income is this one. On that I'll pay 40% tax. How much is the amount?
4 lakhs.
4 lakhs. This is my
Tax.
which I'll pay. That means this is my tax
Payable.
liability. Okay. What is that they are asking? How much income tax expense? So the formula for income tax expense is nothing but
Tax payable plus
tax
liability.
paid or payable, whatever it is, or plus
Deferred tax liability.
changes plus what? Change in, that is change means I am putting delta. Okay. Okay. So deferred tax asset will reduce your taxes or increase your taxes?
Increase, sir.
Deferred tax assets
Yeah.
Reduce.
reduce your taxes. Okay. So difference in DTL, deferred tax liability, subtract difference in DTA. Did you understand?
Okay.
See, deferred tax asset means what? In future, whenever you get profit, you have paid advance taxes, na?
Yes, sir. Yeah.
You already paid that advance tax. So in future, you can deduct it. Am I right?
Yes, sir. Yeah.
And this one you have to pay further. Deferred tax liability means what? You have paid less tax. You need to pay more tax. Am I right?
Yeah.
Yes.
So what would be the answer? Tax paid like
4 lakhs
4 lakhs
plus.
plus. Please find out the difference. The difference is what? DTA 8,000. Oh, sorry, DTL. Okay, 10,000 minus 8,000. Okay, tell me the answer.
1,000. 4 lakhs 2,000, sir.
4 lakhs
2,000.
2,000. Yes. Correct. Okay.
Initially, we have taken the difference of the deferred tax asset for 2 years. We have
Yes,
to find
yes.
out at first.
Yeah. All this is the formula for income tax expense. To find out income tax expense, the formula is tax paid plus difference in DTL minus difference in DTA.
So how much is the difference? We have to first calculate that. Then we have to
Yeah,
invert.
and put in the formula. Understood, na?
Yeah.
Yes, sir.
Once done, we will go forward.
Wait a second.
Yeah. You can take your time. Once if you're done, you have to tell me.
Yes, sir. Done, sir.
Okay. No, Suman is writing, it seems.
Okay, sir.
Okay. So I will show you the formula here. Just a second.
So is it CMA books, no?
No, this is CFA book. So they have given this in a very proper manner, the formulas and all. So I'm just disclosing that to you.
Yeah, okay, sir.
Yeah, 2 minutes. Just it will take 2 minutes. Then we can move ahead with our questions. Yeah, income tax. So you can take this formula. Can you see this formula?
Yes, sir.
Taxes payable plus change in DTL minus change in DTA. Did we do the same thing? Change in DTL
Yes.
minus change in DTA, correct? Hello?
Yes, sir. Yes, sir.
Yeah.
Yeah.
Sir, in the video, you told me that tax payable plus DTL, sir.
Tax payable, yeah, plus DTL, yeah, change in DTL. If you
You
don't
take 2
see,
years
if you have,
case.
yeah, if you have 2 years data, then change. Otherwise, what to do?
Yeah, okay.
That means otherwise you should see that opening balance is 0 and the closing balance is the given amount. So difference is always this amount only, na?
Yeah, yeah. Yes, sir.
Understood, na?
Hmm.
If you have opening balance 0, that means the same amount will be taken, correct?
Yes, sir.
Yeah. So go for the next one. Come on. Next question you have to answer. A liability that represents accumulated difference between income tax expense reported on the firm's books and the income tax actually paid. So liability, you don't have this, you don't have this, you don't have this is the current year tax which you pay as per the tax returns.
Yes.
This is
Only
not,
deferred taxes.
not relevant, deferred taxes, correct? That is only
Yes.
the accumulated difference, na?
Yeah, yeah.
Understood?
Yes, sir.
Next one. Fifth one you do. Fifth one. Okay, no problem. Answer the fifth one also. Not a worry. Which of the following temporary differences will result in DTA? You have to answer this. So one thing regarding DTA, I would like to say you, DTA will be created when, see, this is your financial, this is your net income as per the financial reports. This is your taxable income as per the financial reports. If your net income is 100,000, okay,
Okay.
and your taxable income
Taxable
is
income.
80,000, okay. So you pay tax, 30% is the tax rate. You pay tax based upon this. Am I right?
Yes, sir. In the 80,000 return.
So 80,000 into 30% is how much? 24,000, correct?
24,000.
As per the financial reports,
30,000.
the expense should be 30,000. You are paying 24. So DTL is 6,000, correct?
6,000.
1,000.
Correct, now?
Yeah.
Yeah.
Vice versa. If it is like 80,000 here and 100,000 there.
In which scenario it will be 100,000 there, sir?
See, these two will differ, na? Because you are recognizing something beforehand in financial reports or something like afterwards in tax returns. Maybe some expenditure you have recognized here because because you pay like what we say. See, because of some reasons, maybe you are using diminishing balance method here or anything. This has got
Correct.
reduced. This has got reduced. Let's say there can be any scenario. In the video, I have given scenarios, correct?
Yes, sir. Four scenarios.
Yeah, I have given scenarios because of which maybe here the taxable income is less, and here the net income, that means the financial reports income is more. Then what if these two are same? Do you think any difference is going to get created? No.
No.
Of course, since these two are differing and these two are differing because I gave you a chart and I gave you the reasons.
Yes, sir.
I
Rent
gave you,
paid.
yeah,
Interest
warranty.
paid.
Let's say, yeah. So like because of certain expenditure, which is like shown here beforehand, this income is getting reduced and here we can't show. Let's say outstanding, let's say we are paying some expense, prepaid expenses. What is that?
Prepaid expenses.
Yeah, so we paid in advance expenses. So advance expenses we are showing here. Here we are not showing, let's say. So here the income would be high, na?
Yes.
Correct or wrong?
Taxable income is less and
Taxable income is less and your financial income is high.
high.
Suman, are you understanding?
But my question was, sir, when the taxable income will be high? In which scenario?
It can be high, na? For example, you got rent in advance. So rent in advance means you will be showing here and you will not be showing here. So this income will be high, na, that time.
Okay.
See, I told you now 1,20,000 you received the rent in advance. You received the entire amount in cash and you recognized here. Why? Because this is based upon cash basis. Here you will not recognize that. You will recognize it as a liability. Correct?
Later we will.
Yeah, at the end of the year, that entire 1,20,000 will become revenue for you. Here, like the revenue is shown, recognized at the beginning of the year only. So these two, because of that, differences may be created, na? Or let's say next year's rent you got in the month of December or something. Whatever you got in advance, you are showing here immediately. Here you will be showing later part next year, maybe. So because of that, differences are getting created. This will be high, this will be low. At times, this will be high, this will be low. Okay. That is the reason only the deferred tax asset and deferred tax liability is created. Understood?
Yeah.
So what was I saying? Yeah. So net income is 80,000 and taxable income is 1 lakh. So as per the financial reports, you should pay 24,000 as taxes, but you are paying 30,000. So you are paying 6,000 advance tax. That is DTA, correct?
Yes.
Now you should tell me the question's answer. Which of the following temporary difference will result in deferred tax asset? Come on, read this thoroughly and tell me. It's a very interesting chapter. And question has to be, these chapters questions need to be discussed. Though we are discussing and trying to clear our concepts. Correct, na? You are getting clarity also, isn't it so?
Yeah.
Sir, I think advance rental receipts, sir.
See,
Maybe.
yeah, Yeah, we right now, just now we discussed, just now only we discussed.
advance.
If your taxable income is high, definitely DTA will be created. Am I right?
Yes, sir.
So advance rental receipts accounted on the accrual basis for financial statement and cash basis for tax purpose. Of course, when you're receiving advance rent, like you will be showing the entire rent in the tax returns. Am I right? So the taxable income will be high and DTA will be created. Please tell me yes or no.
Yes, yes.
That's what this is the answer. Very good. Excellent. Yeah. Next question. So you have to find out the DTL and I am expecting answer from you, or else I will solve it for you. Not a problem.
Modified accelerator cost revenue system, which is this method?
See, this we discussed in tangible assets, na MSCRS. They'll give you the rates. Need not worry. These are the depreciation rates.
Okay.
See, as per the as per the gap, you can use straight line and double declining. Okay. But as per the tax authorities, when you file tax returns, they ask you to go for MACRS method.
MACRS.
So differences can be seen because of two different methods.
Okay.
So another 5 years.
Yeah, no problem. Take your time. I will solve this for you then. See, Bearings Manufacturing Company Inc. purchased a new machine on Jan 1st for this much, correct?
Yeah.
And we have to see the what is that we are like finding the depreciation. We have to see. Company uses very simply straight line method. And 5 years is the life, and salvage value is 0, and they use 3 years modified accelerated depreciation. Okay. And the company uses straight line depreciation. Uses 3 years with an estimate. Okay, for financial reports they are using straight line method, and for tax returns they are using MSCRS. Okay. And they are saying DTA at the beginning is 0. See, Kalyani, I used to tell you, na, if nothing is there, you have to assume 0.
Yes, yes.
Yeah. So now the question comes here is we will find out depreciation as per both the methods. Fine. And what did they do? 3 years is given. So what is the deferred tax liability? Oh, they have made the question very simple for you. Only for year one is asking. So let us find out the depreciation as per the straight line and as per the MSCRS method. So 100,000. Yeah. Salvage value is 0. So divided by 5. What will be the depreciation?
20,000.
20,000. Okay.
For the financial purpose, 20,000.
Yeah.
Then MACRS 3 years, that is 1 lakh.
So we will see the asset value.
3.33%.
No, this is the machine value. Now, so first year machine value will be 80,000. And as per this, we take the asset value as like 1 lakh 100,000 into 33.33. It will be 33,333. So when we deduct that from 1 lakh, we get how much value of the asset? 6,66,000. Correct, na?
Yeah. Mm.
Yeah, we get
66,670.
yeah. So like the difference in this two.
6,670 minus 80,000.
So here,
13,330.
yeah. So here, just a second. So what we can do is this expenditure is this expenditure is this, correct?
Okay.
What is the difference between these two expenses? So when you make your financial report, you show your depreciation as 20,000. When you make your tax returns, you show your depreciation as 30,333. Am I right?
Yes, sir.
So difference in these two will create something, na?
Yes.
See here the expense. See, please listen.
88.
Now this is critical part. Here the expense is high. Here the expense is less. Correct?
Yes, sir.
So let's assume that your financial reports you are preparing. So your financial income
Is
will
low.
be high. It will be high, na?
Yes.
Yes, sir.
And here the financial income will be less. Correct?
Yes.
So you will be paying less taxes here. Correct? And as per this you have to pay more. That will create what? DTL. That is right, na?
Yes,
Yeah.
sir.
So here you will be paying more taxes. Here you will be paying less taxes. Here you will be paying more. No, sorry. Here you will be paying more because your financial income is more. Correct? Here the taxable income is less. See, financial income will be more because depreciation is less. Taxable income will be less because depreciation is high. Am I right?
Okay.
Of course. See, here your expense is more, so income will be less, na?
Hmm.
That's the reason why DTL will be created. Correct or wrong?
Yes, sir.
See, I'm trying to explain you something. The same kind of concept I'm giving you. See, let's say okay. Let's say the financial. Let's say 1 lakh has to be the income for these two. Let's say income. Actually, without any differences, they both will give 1 lakh income, na? But here difference is getting created, na? Because of depreciation. Here the depreciation is 20. So what is your income? 80.
80,000.
Here depreciation is 33,333. What is your income? 66,670.
66,670.
Now you tell me you have to pay, suppose 30% is the tax, you have to pay 24,000 here and you are paying how much?
30%. 20,000 only, sir.
20?
20,000.
Maybe something 20,000.
Yeah.
What? Tell me exactly how much.
20,000.
So difference, that difference what you are paying here less is nothing but DTL, na?
Yeah.
Did you understand, Suman and Kalyani?
Yes, sir. Understood.
See,
Yes.
as
The accounting profit is high and
accounting profit is this, taxable profit is
tax-
this. You
so
have less
accounting profit is
taxable
high.
profit. Yeah. So you have to pay. So still you are paying less. So still you have to pay more or not?
Yeah.
That is DTL, correct? So
Yeah.
simply, if you get such kind of questions whereby they are not giving you any incomes here. So how will you find out DTL here? We understood that DTL is nothing but because of the difference in these two expenses, correct? So what is the difference here? The difference is excess depreciation. What is the difference? Tell me.
Minus 20,000. 13,333, sir.
Into 35%.
35%.
4,666.
Finished.
466.
Because this is the cost for that difference. That difference into tax rate is nothing but this much excess to be paid. That is DTL. Okay, just calculate. Understood now?
Yes, sir.
Suman?
So we have just taken the first year ka value, na 20,000 and
They are
33,000.
asking only first year only. They're not asking for next years.
Okay.
So first year the difference is because of these
Yeah.
two different depreciation amounts. And we know that here income will be more, here income will be less. So here DTL is created. DTL
Yeah.
will be nothing but the difference in these two amounts into tax rate. Finished.
Yeah. ATL and the tax.
After noting this down, please let me know. So no problem. We will do the 5 questions, more 5 questions. We'll do tomorrow, and then we'll take up ethics, because now you are also getting some grip on this chapter. Correct?
Okay.
So like, shall we continue tomorrow from 7th? Or you like to do the, okay, do the 8th question afterwards we'll wind up.
Oh, I was making a note.
Okay, make a note.
Just scroll down, sir. You have to make note.
Okay. Down. Okay, make notes, no problem.
Okay.
Yeah. Now, okay, then do the 8th question. Then we can wind up. More 4 questions I'll explain tomorrow. If we get time, we'll start ethics immediately tomorrow. So a tax rate other than current tax rate may be used to calculate deferred tax income amount on the statement of financial position if see current tax rate, if at all, is going on prevailing right now. So like in future, definitely what the first you try to understand the question, a tax rate other than current tax rate. That means currently some tax rate is going on. Let's say the tax rate is 30%. So other than this, we will use, okay, to calculate the deferred income tax amount on the statement of financial position if future tax rate has been enacted into law. That means if they change any tax rates, we'll apply that rate only. Correct?
Right.
That's what. Okay.
Okay.
Yeah. If changes happen, then we'll apply that. No, otherwise we'll continue with the rates with which are not changed. Correct?
Yeah.
These are the questions. More 4 questions are there. We will wind up those 4 questions tomorrow. Okay. And start ethics. Fine.
Okay.
Yeah. Thank you.
Thank you.
Thank you. Please practice. Yeah. Thank you.